Hello and welcome to the Currency Exchange NatWest Markets podcast, where myself, Eimear, Daly, and our team of FX market strategists help to break down the main themes and events driving currency markets into weeks ahead. Today, I'm joined by Alvaro Vivanco, our EM and ESG head of strategy research. Alvaro, since we last talked, a lot has happened in financial markets. We were previously all fixated on inflation dynamics globally, but obviously now concerns have focused on risks to the banking sector. And we've obviously had a more dovish Fed pivot. How have you viewed how EM FX has reacted to this and what you make of the latest developments?
Yeah. Hi, Eimear. Hi, everybody. Thanks for joining the podcast. Clearly, very, very exciting couple of weeks. I think kind of the first principle to some extent, right, and there's some caveats about it, but in general, right, investors cannot be concerned about two opposites at the same time. So for emerging markets at the beginning of the year, and certainly last year, the main concern was higher US and global interest rates, right, that were pushing especially the dollar higher. And now, really abruptly and suddenly, we are in an environment of lower interest rates, expectations that the Fed is going to end the cycle soon, or maybe it has actually, concluded the cycle and they're not going to hike again. So between these two things, right, we obviously went from one extreme to another. And I don't think that, significantly lower rates, especially if they take place in an environment of uncertainty and concerns about the global financial system, that's not positive for EM for sure. But what we have seen just this month is that emerging market currencies have actually performed very well across the board, right? With very few exceptions, most currencies have actually appreciated against the dollar since the concerns about regional banks in the US and European banks started a few weeks ago. I think that that's very important. And it tells you a couple of things. I think the first one is that there is demand for emerging markets. There's a demand for carry, that people are fairly comfortable with it. The positioning in some of these currencies was already quite high, right? There was a few popular trades. We talked about Mexico. We talked about Hungary in your region being kind of obvious trades that benefited from very high carry, very high yields. The fundamentals are obviously very different between the two countries. But what we have seen is that even in those cases, right, where people had already those positions, the initial reaction to the shock was significant. But since then, they have recovered quite a bit and people seem to be coming back to them. So I think that there's like a longer theme going through that this is still a period in which people want to switch away from the dollar to some extent, away from other developed market currencies into these emerging markets. So far, obviously a lot of concerns. I don't think that we can claim that the story is over, but I think it was a very important test for emerging markets. And so far it has done very well.
And you mentioned about, the Fed shifting more dovish. How have EM central banks themselves reacted? Have they changed their policy outlook?
Well, we're in the process of that, right? We have some meetings coming up today that will give us some clues. What we have here, we're hearing so far is that central banks don't like, all central banks in emerging markets don't like this uncertainty, don't like this volatility, right? It's, even though conditions are obviously very different, the reflection back to 2008 comes back when people hear about financial conditions tightening, about concerns about global banks. They're obviously worried about it. And I think the reaction has been the natural one, which is EM central banks have already tightened quite a bit. There is still a lot of inflation concerns in the pipeline, and they're not willing to give up quite yet. They're not willing to ease, even though, otherwise in terms of domestic conditions, it will seem like the right time to perhaps end the cycles or even start easing in some countries. I think all this external volatility makes them a little bit more cautious, a little bit more reluctant to jump into that until we see how it's evolving. As I said, things over the last few days are evolving the right way. So, we can go back to some conditions in which central banks started signaling that they are done. But I think for markets, it has been the right reaction, which is central banks have been more hawkish. But actually, it has been in your region that we have heard from some of them. So I wanted to throw the question back at you and see, what are they saying in the ones where, we have some official communications since the external environment started becoming
Yeah, so in my region, we have both Hungary and the Czech Republic. They kind of had to make a very tough policy call in the middle of all this volatility. And, it absolutely corresponds to what you're saying. It's kind of a safety first message. So for me, I think Hungary was the biggest change. Actually, in their last meeting, they kind of changed their interest rate forward guidance. So really what would have been usually a precursor to a rate cut, that was completely revised in their meeting this week. So, they previously said they saw a trend-like improvement in risk perception, which is really code for we've got a stronger currency, which is better for our economy and for inflation. They revised that. They said, it's an adverse risk environment. Risks are high. We're monitoring it. I thought what was interesting is they did a scenario analysis of 4 different scenarios about how the situation globally could evolve, and one of which was a massive outflow from emerging market assets that clearly have had a very stark reminder of, the currency depreciation that they could, feel if it's an adverse market reaction for emerging markets, they could really be vulnerable to it. And Czech saw the same. So they very clearly pushed back against market expectations of tightening. So hopefully central banks are being quite conservative and very much safety first. But given this, if central banks kind of hold the line, do we think that it is carry is king?
I mean, that's something that we have been saying for the last few months, and really is one of the principles of why we have been positive on emerging markets since last year. But I think it's important to note that it's not carry and just carry, right? It's carry, especially in those countries where the fundamentals are also solid, right? The balance sheets are in good shape. There are no concerns about debt sustainability, right? Which, other countries, smaller, more niche markets are going through some pressure points because they borrow a lot. And now that the Fed is increasing interest rates, they're feeling that pressure. But, for the large liquid emerging market economies, that is not really an issue. Growth expectations have started to improve quite a bit over the last few months. The mix versus inflation is also improving as, central banks have tightened. So it's just not carry for the sake of, chasing carry. It's carry in a context where everything else makes sense. And I think now, especially if we are closer to the end of the hiking cycles for developed market, I think the debate and kind of the flows are going to move towards the longer end of the curve, right? These are countries that for the most part, in terms of the fiscal response, it has been adequate. There's some exceptions that we have been highlighting, but I think, the yields towards the longer end of the curve, have been attractive for a long time. The constraint has been, let's wait to see where the Fed ends up. And to the extent that we're getting closer, clear idea of where that might be, I think that, for the next few months, that's where we can really see some of these fixed income flows consolidating, which will help the curve, but it also, in the vast majority of countries, will help the currency because the carry at the front end is so high that it's really the exposure to the currency that provides that valuation, that momentum.
And when you talk about high carry, your region, LATAM, really stands out. Are you still positive on Max and Brazilian Real?
Yeah, I am. And I think there's really no reason to change that. Again, we'll see the policy reaction from Mexico today. We have other countries that we are a little bit less optimistic just because of the levels and some concerns. But yeah, I think that if you look globally, right, Mexico and Brazil are actually pretty straightforward in terms of fundamental story. There's some political noise in Brazil that's declining. So I feel that in both cases, the levels are different, but I think the rationale to be long, is still very, very strong. I think in some cases, it has been your region that has, brought some headlines on the political side. Israel, obviously, you have had a good call on that. Maybe you can give us a little bit of an update of how your view has changed in light of, the developments in both directions recently.
Yeah, so my region is definitely causing some volatility in recent days. We had very dramatic events unfolding in Israel. So, kind of the main focus has been the government's attempt to really overhaul the judiciary, which some claim is kind of undermining democracy in Israel. So, over the weekend, we had, the highest, most senior government official so far coming out and criticizing the judicial legislation. He was subsequently dismissed from government, and we had mass protests on Sunday night. And on Monday, we had, paralyzing strikes across the economy, really, shutting down whole sectors. Because of this, the Prime Minister Netanyahu was basically forced to come out in a public address and announce the delay, which I think is the key word of this judicial legislation. So it's really assets really rallied off the back of this. There's real signs of hope that this was kind of a return to more normalcy, to more orthodox governance. I would say I'm a little bit concerned that this is a bit premature. It's not just Netanyahu's decision actually to progress this legislation. Actually, kind of the survival of his kind of very broad coalition government really depends on it. He formed a coalition with ultra-orthodox parties, also the far right. And actually, in terms of policy asks, this is kind of the lowest bar. Some of their other policy demands could be a lot more contentious than judicial reform. We saw actually the police minister, in agreeing to this delay, basically got command of the National Guard, which people say, could be used as a militia force. So some really worrying signs. Even though, the legislation has now been delayed until the next parliamentary session, so the 30th of April, and there will be a chance for the different parties to try to form some kind of compromise. But if they don't, it will go back to a vote in the next parliamentary session, starting for the 30th of April. So I do think we could see a slight reprieve in some of the Israeli assets, but I wouldn't be going headlong into this rally. I do think recent developments have kind of exposed some of those big risks and have left Israel a lot more kind of internationally isolated on the global front. Well, kind of bringing us to a close on that very pessimistic front, I guess the key thing is, we watch for in EM going forward. What are the key kind of catalysts, which will help us kind of gain more confidence in a move back into carry going forward?
Yeah, I mean, I think what you just said is interesting, right? Israel has been very unique in terms of these political headlines really heating up. I think for the rest of the countries, it's been mostly driven by the external environment. And, in terms of domestic factors, it really is carried to volatility, is the macro side. And I think politics and policy, have been a little bit in the background, which is good for emerging markets as a whole. So, as I said before, we are keeping our bullish stance in some of these currencies, not all of them. We can, the readers can go through some of our recommendations in our research. But I think what's going to be important is obviously for the external conditions, the credit markets to continue to heal over the next few weeks. I think that there will be some other news, right? Other sectors that affect the banking system globally because of the shifting of conditions globally. I think we should expect those to happen. In terms of emerging markets, as I said before, is this balance between the effects of the previous tightening that has already started to seep through the economy versus improving growth expectations. I still feel that there's a little bit of momentum from the Chinese reopening, right? That has really not impacted emerging markets as a one-time shock. I think is seeping through, but obviously is positive for a lot of commodity exporters. And then just the central banks. And in a way, this noise makes me a little bit more comfortable that they will be careful about moving too soon to easing conditions, which, as we said, is critical. So for now, those are the things to watch. Hopefully, things calm down, continue to go well. But as I said at the beginning, I think the test was very strong for EM, and I think compared to previous episodes, of external volatility really, causing disruptions in the market in emerging markets so far is going well.
Yeah, hopefully current financial markets continue to recover, and we're going to move back into some of those high quality carry plays in EM. Alvaro, thank you so much for joining me. And that's about all we have time for this week's episode. If you did like the episode, please do click like so others can find us, and do subscribe so you get the latest episode first. Thanks again.